Canada's mortgage rules may be changing and in for an overhaul as soon as this year. This is big. This is big, and I've been warning about this for quite some time. Canada's banking regulator, OSFI, is considering changing on how homebuyers qualify for mortgages. If this happens, could be way more far-reaching, not just for people borrowing money, but even for banks and the brokers that are finding you the mortgage. OSFI, which is the Office of the Superintendent of Financial Institutions, is evaluating a shift from its current mortgage stress test requirements, which requires a borrower to qualify at either 5.25% or 2 percentage points higher than the contract rate that you're given. That's how it is currently. If OSFI does change this way of qualifying for a mortgage, they will change it to what's called a loan to income or an LTI approach, where this involves a debt service limit as opposed to interest rate affordability. Now, when OSFI implemented the stress test, it worked. We were in a very low interest rate environment. And so OSFI wanted to make sure that if these incredibly low interest rates were to ever increase, that people that were qualifying for the mortgage would get approved. And it worked. I mean, quite frankly, it worked. We were in this really low single digits. We were talking like 1 and 2%. And rates did indeed go up. And those that got qualified for a mortgage were qualified at 5.25. And at some points, they were even qualifying for higher than that. When rates were getting up higher and higher, we were actually qualifying people at 7% and 8%, sometimes even 9% when rates were at their highest. Now, in those cases, it wasn't really working. It wasn't needed as much because, I mean, we were definitely higher than the 5.25%. And at that time, 5.25% compared to the low interest rates that we were in seemed to make sense. But now we are in a rate environment where technically we're going down. And now what OSFI wants to do is they want to regulate the amount that you can borrow based on your income, not on whether or not the interest rate is high enough for you to afford. That means that if this loan to income type of idea were to come about, OSFI would regulate a borrower's income to 4.5 times their gross annual income on the mortgage that they can be approved of. If that were to come, theoretically, it could come as soon as the end of 2025. But if that were to come, that would devastate, and I mean devastate, markets like Vancouver and Toronto, because there is nowhere that you can buy a house at 4.5 times the borrower's gross annual income. I will tell you right now, if the average house in Toronto is well over $1 million, or let's just use $1 million for round numbers, 4.5 times that income, qualifying for $1 million mortgage, would have to be making $222,000. Clearly, there's not a lot of people making $222,000, especially first-time home buyers. So it would make it very difficult. And to put the cherry on top, what would make it even more difficult is if the two requirements for mortgages came into effect at the same time, because there theoretically could be an overlap with the current stress test model and the idea of the loan to income model. That would be catastrophic. But I will say that the loan to income model is not new. It is being used at many places across the world, including the UK. So theoretically, it is being used and it is successful. But if you add these two together, the stress test, and if you add the LTI approach, it'll annihilate the market.